So why do venture capitalists make predictably bad investments? I came across this 2022 paper from Dr. Davenport from Princeton, who's a researcher in behavioral decision making and AI. The title of the paper is Predictably Bad Investments, Evidence from Venture Capitalists. Machine learning can be very valuable for venture capitalists, so to adopt like a new tool to be able to predict what is a good investment and what is a bad investment. The bold statement that Dr. Davenport makes is that up to half of VC investments are predictably bad. So today we're discussing the general structure of the paper. We're going to discuss the method first, the data points, the structure of the argument, a few very interesting conclusions that one can take from this paper, and then finally unveil a few of the limitations of this paper. So let's go and dive into that. So we will discuss in particular two outputs that can be very interesting and that can be very informative for venture capital decision making. Number one, we're going to talk about machine learning prediction versus liquidation event. And the question here is whether is there a machine learning algorithm that can significantly predict interesting and valuable elements that can actually signal what's going to happen at time 2 after the investment. Secondly, we're going to focus on whether we can identify predictors that can actually tell something valuable about how to forecast what is interesting about a company. So first of all, we're going to start from basic definitions that are used through the paper, and I think it's helpful to actually unveil them and disclose them so that we can use them later on in the paper. Then we're going to distill a few interesting points that can be derived from the paper, from the employment of machine learning algorithm up to founder characteristics that can be meaningful when assessing an investment decision. At the end, we're going to basically look into a few limitations of the paper, look at some meaningful conclusion, and then suggest to the listener a few resources that can be interesting to dig deeper into the topic. So let's start from the framework of the problem. So in general, any investments in the VC space can be framed as a 2-period prediction problem. So essentially we have a time 1 where we do understand what is the situation of the company, what kind of signals are we taking in order to assess the value of the company, and then time 2 is essentially what is considered the exit event, the liquidation problem. So in the startup lifecycle part of the paper, the simple 2-period game refers at the time 1 when the prediction policy problem, the evaluation problem we mentioned, is unveiled. So early stage investor evaluates startup and try to decide what and whether they're going to invest. The second period is the outcome realization, which is essentially the liquidation problem at time 2, when actually the investment done at time 1 will have positive or negative consequences at time 2. What is interesting is how exactly Dr. Davenport define an exit. In this paper in particular, Dr. Davenport define exit in 3 particular ways. So the first thing is IPO, classic exit. Second one is an M&A activity, when actually the startup is bought by a bigger company. And third, any series that is above the Series C round. The paper then defines the probability of an exit. So this is interesting because actually it's basically a direct function of theta and t. So essentially the probability of an exit of startup I is essentially equal to theta plus t. So theta being the intrinsic quality of the startup at time 2, so at the second time frame, plus what is defined as the treatment effects of funding at time 2. So essentially, what is the valuable effect of funding which have been deployed in time 1 in time 2. A few interesting elements and distinction that Dr. Davenport does is that both theta and t, as we described, are both dependent on what he calls x and z. So x being basically essentially all the characteristics of the startup which are observed both by the investor and the researcher, and z, which on the contrary are only the characteristics observed by the investor. So essentially, he wants to actually separate what is available to researchers and investor versus what is only available to investor, and this will become relevant after. So let's talk about expected return as well, because expected return is something that will play a role when we are going to define what is a predictable bad investment. So expected return is a function of theta and t and is defined as essentially the probability of an exit times the MOIC. So this is the kind of return that the investor should expect. So MOIC in general is the multiple on invested capital, and the definition is standard and plays like a substantial role in defining expected returns. Another core element is to notice that returns is basically a function of x, z, and b, where b is actually the bias, the behavioral distortion that might take place into the decision-making process. So again, x being essentially the information related to the knowledge of the investor and the researcher, z being the information related only to investor, and b being everything that is behavioral. So B is an interesting element because it takes into consideration any non-standard element which are included into the decision-making process. These include essentially non-standard preference structure, exogenous elements, and anything that is like a possible constraint to the investment decision. One of the last basic elements that the author wants to include, and that's functional to define exactly what is a bad investment, and so there we come back to the core of the question, is the variable rho. So rho being essentially the expected return from some outside option. So the idea here is that in order to build a sense of what we can define as predictably bad investment, then we need to understand what is the rate of return and how to compare it to rho, which is this exogenous rate of return. So from these kind of elements, what we can say is that the investment decision problem is essentially, if we take it from a normative standpoint, then the investment is a green light if and only if then the expected return is bigger than an alternative rate of return that in the paper the author defined as rho, which is essentially an external rate of return, which is a benchmark for any other kind of investments. In this paper, in general, the author is trying to use machine learning to predict how successful a startup in the late stage of its life is going to be, based on the information that one can collect at T1, so the early stage part of the life cycle of the company. The machine learning algorithm only uses X, which is essentially the available information that are available to both the researcher and the investor, and it pretty much cuts off anything which is biased and pure information that are available to the investor. In this way, the model is expected to behave in a very clean and unbiased way. So a predictable bad investment is an investment that has been accomplished, so capital has been deployed, despite the fact that at time T1, we perfectly know that the expected rate of the return generated by the algorithm is actually less than rho, which is the benchmark, the outside expected return. So let's talk about data. The data used in this study is essentially 16,000 companies that have been pulled in from PitchBook, PitchBook being the main source for early stage and late stage investments. All the information from PitchBook are essentially clean in a certain way because they basically include only the information that have been available at the time T1 of the investment. So the assumption here is that information has not changed over time. So any predictor that we can find at time 1 is actually being computed, is being used for computation to actually predict what's going to happen later on. If we talk about predictors, then there are like 3 specific elements. 1 are information from the company, 2nd are the founder information, and 3rd are product information that again we assume have not changed across the life of the profile and information available. The goal of this data set is actually to extract through machine learning some predictive signals that can tell us something informative about the late stage deal and how early stage information can tell us something meaningful of the later performance of the deal. So let's talk about sample construction. So when we talk about sample construction, this data point come from a precise selection of companies that have been part of one of the top accelerator, so the top 100 accelerator and incubation program between 2009 and 2016. Every company has been then tracked for about 5 years as they completed each single accelerator or incubator batch. The author then split the sample into two, using one sample for training and then one sample for valuation. The sample for training are companies that have been essentially into the incubator between 2009 and 2014. And then starting from 2014, then that is the data that has been used for evaluation purposes. So what we have here in absolute number for the machine learning algorithm to actually process are about 16,000 companies total, 5,440 early stage investment, and then about 467 late stage transaction that follow pretty much the definition that we discussed earlier on. Let's talk now about the algorithm construction. So the author uses the famous XGBoost, which essentially is a readily available method that uses the gradient boost in general, of course expanded, in a way that can capture meaningful information given the data. So XGBoost is used for predicting the success of startup based on a range of input features. This can include like the founder educational background, the funding rounds, any other information about the product. The good thing is that XGBoost is essentially a very catch-all sort of model that can really well perform and efficiently provide extremely useful insight on a variety of topics. So now let's talk about what are the main insights that we can derive from the work and the leverage of the machine learning algorithm once it's applied to this kind of data set. So first of all, let's focus on figure 2. The algorithm has found a signal. So basically what it shows is that there is a monotonic relationship between what is considered predicted success versus observed success. So the x-axis in figure 2 refers to the quintiles of perceived such success, which is essentially how exactly the machine learning algorithm will provide a score for what is considered a predictor of success. So from 1 to 5, the different quintiles, 1 being the lowest, while number 5, the fifth quintile, essentially being the one with the highest probability of success. So the y-axis, on the contrary, it contains what is considered observed success, which is in the form of rate of any liquidation event. So this rate indicates a proportion of startup in each quantile that achieved a liquidation event. So it appears to be an upward trend, so the monotonic relationship is there, not necessarily linear, but definitely monotonic, where essentially as the predicted success increases, then we also see an increase in the rate of liquidation. So this implies that the machine learning prediction model is actually positively associated with observed outcomes. This gives us a sense that it is possible for some machine learning algorithm to actually give us some predictors on what's going to be the probability of a liquidation event of the future based on the information which are considered in the early stage phases of a company. But how good is the model? Let's consider figure 4, the standard ROC curve. So ROC curve stands for Receiver Operating Characteristic Curves, and essentially gives us a sense on how good a machine learning model is in predicting elements from the dataset. So the x-axis refers to false positive, meaning that how good is the model in avoiding what is predicted as positive but actually is a bad investment. This measures how good is the model in avoiding bad companies, essentially in this specific case. So something that is predicted as good, but when observed that is actually bad. The y-axis is sensitivity. Sensitivity measures the true positive rate. This measures essentially how good is the model in picking the right companies. The way we measure how good the model is essentially by calculating the area under the curve, being 1 the perfect model, which essentially hits is a home run, and for each single predicted element, then there is a corresponding positive observed element. So if the area under the curve is 1, that basically means that the model is perfectly predicting. If the area under the curve is 0.5, that means that is essentially a 50-50 chance. What we're observing is a 0.6, which essentially means there are some predictors, the model has some predictive power, and it tends to be away from just a random guessing. In addition, the confidence interval is pretty tight, meaning that the model is pretty accurate too. But what exactly predicts success? So despite the fact that the model might show actually some interesting signals and some monotonic relationship, as we've seen before, it is actually pretty difficult for a lot of models to actually pinpoint which exactly are the predictor that determines this positive relationship. In order to answer this question, let's check table 6. So table 6 is essentially trying to relate inputs with predictions. So on the x-axis, what we have is the dependent variable, which essentially is the algorithmic prediction of success, which is in quintiles from 1 to 5, as exactly before. And then on the y-axis, we have the independent variables inputs used in the modeling part. The coefficients of the table, basically what they show is the estimated effects of each independent variable on the dependent variable. So exactly how exactly each independent variable on the y-axis relates and weights on top of the dependent variable on the x-axis. So positive signs clearly defines a positive association, a negative sign indicates a negative association. So what the table shows is that there are actually some predictor of success that can be identified in the early stage of the company and that weight to the late stage part of the exit. Two particular features of the startup that are interesting to notice. One is the educational background of the founder. So one of the highest coefficients into the table relates to education. Education has been historically used as a proxy for how exactly the company will behave in the future and how successful it will be. Apparently, there is some evidence, some scientific evidence to that. And secondly, is the prior history of investment. So whether a founder managed to actually raise some capital before. This is also proxy which has been used, and according to these studies, it's pretty much been validated as well. So let's now examine really briefly figure 6, which basically puts together and put into the same table returns and the rate of success. So essentially here the author is trying to actually see whether a good predictor for rate of success in terms of liquidation, in terms of exit, actually relates to what are the actual returns at the end of the process. So the idea here is basically saying, okay, if the algorithm can actually predict and be a very good predictor for exit, that does necessarily mean that also returns are going to be properly predicted in the same pattern. So according to figure 6, it seems that it's not exactly the case. So figure 6 doesn't really show the monotonic relation that we hoped for. Essentially, the predictive power shows some trend, but is more of a Gaussian form. That basically means that the monotonic relation is not quite there, so there is no particular relationships. So let's go to the core question then. Why exactly VC make predictably bad investments? In order to answer this question, Dr. Davenport took a different approach by training the model actually on the top 30 VC firm and on the bottom 30 VC firm to actually try to uncover what are the decision parameters that they use and whether there is some difference into that. So after performing a lasso regression to find coefficients, Dr. Davenport put in the same table on the different axes, basically those coefficients, to actually see how top performing firms relate to low performing firms when it comes to what elements do they evaluate. So the conclusion is very insightful in that it shows how exactly the top 30% firm make decisions about early stage investing versus the low 30%. So essentially, the worst firms overweight founder details while the best firms prioritize product details. This is interesting. This is against the general convention that founders need to have like the spotlight whenever it comes to investment process, especially in early stage phases. These numbers seems to show that actually the best performing firms are actually weighting product way more and essentially giving us a completely different outlook on conventional wisdom on VC investments. So another big problem is that it seems that VC space, and I quote, is the perfect storm allowing decision-making biases to persist. So the VC space is really like plagued with a lot of different biases that are very, very hard to get rid of. So first of all, we can find how exactly there is a big narrative about founder first conventional wisdom, where the founder is the priority when it comes to early stage, and it pretty much takes much of the weight when it comes to decision making. Secondly, the definition of success. What Dr. Davenport says is that it's not really clear how exactly early stage firm in venture capital define success. So it's very, very tough to pinpoint exactly a pure definition of success, which is objective. And basically the topic is not well studied, and it would require further study and further interest. The second element that also is included is overconfidence. So basically, all the logic when it comes to investment decision making are still there. Individual VC investors tend to actually have overconfidence of their capabilities and have a hard time actually including a lot of like different tools such as machine learning models and whatnot. Let's talk about some limitation of the paper. So first of all, I think that there is some uncaptured patterns from data limitation. So essentially, the model is essentially taking care of what is visible and what is already available from the database, from PitchBook. The truth is probably that there are some information or a corpus of information that is only available to investors, and it would be very interesting to actually see how this investor-only knowledge actually will play a role into the machine learning model, and whether this would actually change the conclusion and the correlations of what constitute a good or a bad investment. Talking about startup success parameters that have been identified before, meaning elements, specific elements in the company that needs to have a weight when it comes to defining whether a startup will be successful or not, they have particular limitation in that if we actually consider the statistics there, the R-square coefficients is not as high as one might expect. So the value being 0.166, which basically saying that R-square is there, but the model doesn't explain a majority of the variance in the startup success. Let's now conclude by focusing on some key insights. Number one is, I think, predictability of success. So there is here like an initial strong argument in favor of the usage of machine learning algorithms when it comes to investment decision making, mostly for two reasons. First of all, because actually they can show monotonic relationship of different variables, and the more the model will evolve in the future, the easier and the clearer those specific variables will be uncovered. And secondly, what is interesting is that challenges pretty much the intuition of VC investors. So again, VC tends to be an intuition-based business to some extent, and everything here is basically trying to disprove that, saying that ML might actually play a role. Another insight is that biases of reasoning are still there into the decision-making process. Systematic bias, conventional wisdom, they all play a role into the decision-making process, and certain feedback mechanisms contribute to the pattern of making poor and actually predictably poor decision-making for investments. A third insight is what we discussed before about how exactly top-tier firms make decisions compared to low-tier firms. The data show that it seems to be better to actually take into consideration way more the product element rather the founder element. So to conclude, what is interesting about this paper is that it makes, and it actually start making a very, very strong case for high algorithmic selectivity in the investment process. Meaning that, as probably one can start thinking about, ML will play in the future a very, very structured and interesting role in the decision-making process of investors. Let me give you a few references in case you want to dig deeper into this topic. There are 3 papers that I think are worth mentioning at this point. So one refers to the determinants of VC choices from Leone and Stern, 2022, called Venture Capital, Allocations in the Age of AI. Very interesting paper, very focused on venture capital decision making. A second paper worth mentioning is the Kleinberg Human Decision and Machine Prediction from the Quarterly Journal of Economics. So essentially, this is a broader perspective on how machine learning is answering economic questions and economic choices in general. And finally, when it comes to the counterintuitive element on, using betting more on the product than the founder, that raises the big question in VC, which is the horse versus the jockey problem. And here we have a good paper from 2020 by Gompers and Gornal, How Do Venture Capitalists Make Decisions, from the Journal of Financial Economics. Thank you for joining for today's episode, and thank you for your interest.